everyone. My name is Jason Van Dyne, and I'm the president and founder of AQuest Wealth. To all the familiar faces, I hope you're doing well, staying warm. It is just so miserable, this week, down to, 1 or -1 every night. We're going to focus now. It's tax time, so we're going to focus a little bit more on what may happen to your tax situation. And we're going to break it down into three things. We're going to kind of have changes that are already happened, so some things that have already changed for 2021. And then we're going to talk, secondly, about changes that can happen this year to your personal taxes. And then we're going to talk a little bit about the stock market at the end and how some of the business changes, could affect any of you who might own businesses or, some of the larger businesses, in profitability in the market. And kind of what this is meant to be is not a master's class in taxation, right? This is informative. It's kind of what's going on. And, it's interpretation and explanation. So what is going on and how might it affect you? Anyone who has questions today, feel free to ask them. If you've got some super specific or in-depth questions, I would say feel free to reach out to your AQuest, either tax or financial advisor. This is basically, this page just talks about a few of the things that have already changed so far this year, as well as just making sure we're speaking the same language. So a few of the things that have changed are, small potatoes type of stuff. Every year due to inflation, the standard deduction goes up. That used to not matter a couple of years ago, but now due to some Trump tax law changes, more and more people are doing the standard deduction instead of the itemized, or some people call it the long versus the short form. It did go up from $12,200 to $12,400 for single people, and from $24,400 to $24,800 for married couples. Again, just to make sure that we're talking kind of the same language, if you look here, you can see that these are the tax brackets. And from 0 to 19,750, you're, of course, in the 10% bracket. If your taxable income, which is total income minus all of your deductions, were to be $19,751, right? You would jump into, a lot of people use that terminology, jump into the 12% tax bracket. I think it's kind of that terminology and things like that that have led to a misunderstanding of how the tax brackets work. So just to make sure we're kind of all speaking the same language here as we go to explain this, if your taxable income is $19,751, you didn't really jump into the next tax bracket. You stuck a pinky toe into the next tax bracket. Only that $1 would be taxed at the new higher tax bracket, which is 12%. And all of the previous money would still only be taxed at 10%. And that's true no matter how high you go. So if you make $1 million a year, still the first $19,750 that yourself and your spouse make would be only taxed at 10%. Again, so the standard deduction increased a little bit. Some of these numbers here, the tax brackets, increased a little bit. Again, relatively small potatoes, but it was worth talking about. And again, just making sure that we're all speaking the same language when it comes to taxes. So tax savings. There's a couple of, I think, relatively interesting things that have happened with tax savings this year. So you can see 401ks have increased a little bit. So, we have a lot of clients who are very, in a positive way, militant about they want to max out their 401ks. That's why we like to do this at the beginning of the year. You do have the opportunity to save a little bit more. The maximum went from $19,000 to $19,500. Also, the catch-up contribution. So for people over 50 years old, last year, you could put in an extra $6,000. This year, you can put in an extra $6,500. Same things with simple accounts. But I think this is interesting. So for the first time in a while, in your IRA contribution limit does not equal your catch-up. So the IRA limit was $6,000 last year, and that would go for after-tax and Roth IRA as well. But this year, it's also only $6,000. So that did not go up, nor did the catch-up for the IRAs. So again, if you're over 50, you can add in an extra $1,000. So again, your 401k, 403b, 457 plan, whatever your retirement plan is through your employer, that did go up a little bit this year, but the traditional IRAs did not. Savings and contribution limits. The Roth IRA contribution limit, as we talked about in the last slide, did go up, from stayed the same at 6,000. Plus, you can add another $1,000 if you're over 50. Also, the IRS is going to limit, just like they did last year, but it did go up a little bit. Again, very small amount, but it still happened. It could affect some of our clients. So if you are working and you have earned income, that's adjusted gross income. To find adjusted gross income, it's the last number on the first page of your tax return or it follows through to the top number on the second page of your tax return. That is adjusted gross income. So adjusted gross income is total income minus deductions, which equals your adjusted gross. If your adjusted gross is between $198,000 and $208,000, you can contribute to a Roth IRA. That confuses everyone. Everyone says, well, what do you mean? Why is there this spread? It's what the IRS calls a phase in. Quite frankly, I think it's silly. I think they should just pick in the middle and say, if you make more than this, you can't contribute. If you make less, you can. But they phase it in. So for example, if you were halfway in between 198 and 208, right, then you could contribute half to your Roth IRA. So that's how the phase in works. A lot of people in our client that we work with, that we have as clients, do make over that, which is nice. And I think this is a good spot to maybe talk about what's called a backdoor Roth IRA. I know that we talk about it a ton here in our office, but for those of you who either may not be clients or who may be relatively new on the webinar, a backdoor Roth IRA is the contribution limits are still the same. So it's $6,000 and then $1,000 if you're over 50 per person, as long as you have that much earned income. But if you have over 208 and you can't do your Roth, what you can do is you can add to an after-tax IRA. So it differs from a Roth a little bit. It is after-tax money, so not pre-tax like a regular IRA, but after-tax like a Roth. But it doesn't have all the advantages of a Roth. The growth you don't pay tax on, but then when you take it out, all of the gains are taxed, and they're taxed at your ordinary income rates, not capital gains, and capital gains are more advantageous than ordinary income. So on its face, you'd think, why in the world would anyone ever use this? Where people use it is if you do phase out of that Roth IRA and you are able to make an after-tax IRA contribution, then you can do something called a Roth conversion. So you can take that money out of the after-tax IRA and then move it over to a Roth. And that you can do that every year, and that's an unlimited amount of money that you can do. So for people that are kind of phasing out of the, of the Roth IRA because of income limits, you are able to, do an after-tax IRA and then convert it. What I would tell you is talk to your advisor before you do that, either your financial or tax advisor here at AQuest, because if you have other IRA money, it gets a little bit more complex. So the perfect case scenario would be someone who's had one job and they have a bunch of money in their 401k. They're making a good living, either individually or between them and their spouse. There's no other IRA money. All of your money's in your retirement plan for maybe one or both spouses. And you can then make that contribution and convert it, and you're fine. If there's other IRA money, it gets a little bit more complex, and we'll be happy to walk you through that. I don't know that it makes sense to do it, in such a public forum, because it probably doesn't apply to everyone. But if you can't do your Roth IRA, there are other ways to get money into a Roth. This is a big one, the death of the stretch IRA. Until a month and a half ago, if you passed away and your children inherited either your IRA or your Roth IRA, they could take a little bit of money every year. It's a required minimum distribution. We'll use that term a couple times today. So you can take a required minimum distribution that's based on age. So most people are used to this idea in your 70s, but there actually is a table that goes all the way down to, babies. So if you inherit money and you're in your 20s and you had an IRA, you had until a month and a half ago, you had a required distribution that you had to take. It was very, very small, less than 1%, but you still had to take it. And so I'm 42 momentarily. I'll be 43 pretty soon. So if I inherited an IRA from either of my parents, I would, until a month and a half ago, have been I could keep it an IRA, but I'd be forced to take out a little bit every single year. And I could do that for my entire life. Now they made a pretty big change, and they said that is gone now. And instead of stretching it out for the entire life of your beneficiary, that beneficiary has 10 years to take it out. But there is no requirement to take out any amount in any given year. So for example, let's say I was 60 and I inherited money from my parents, which would be great. I would love for them to live another 17 years. And that's possible, of course. So if I inherited some money from them when I was when I was 60 and I was still, earning money, I might not want to take that IRA money out because I don't want to pay tax on it. But let's say I was retiring at 66. I could theoretically take no money out now for 6 years. Then when my income tax bracket was lower after I quit my job, then I would want to maybe take some of that money out of the IRA. So the kids have, in a way, a little bit more of an opportunity for some creative planning, and in a way, a little bit less of an opportunity for some creative planning. So it's worth making sure that We have probably, whoever your advisor is here at AQuest has met your children or at least knows them, so that at the time, when the time comes that this money is to flow to the next generation, that we have at least a plan. And if we had a plan before, we now need an updated plan on how they're going to deal with this, with this inflow of assets. So I think that was a pretty big one. So I wanted to spend a little bit of time on it.